The way you pay your financial advisor isn't just about how the money leaves your account. Your payment choice actually determines two pretty important things. The first here is it determines who you can actually work with. Different fee models come with different minimums, account requirements, types of advice that person will offer. Some advisors aren't going to work with you unless you have a certain amount to invest with them. Others require you transfer your accounts over to their management before they'll offer advice. The fee structure shapes the entire relationship before it even begins. Now, the second thing here is it determines how much you'll pay. And I don't just mean that sticker price on the upfront cost. I'm talking about your total cost over time. It can vary dramatically depending on the service model. Now, different fee models can also create potential conflicts of interest. That doesn't mean every advisor in a given model thinks or acts the same way, but it's worth understanding how the structures work so you can ask the right questions and find the right advisor. Most people never think about any of this until they're already working with somebody, and by then, they've already made their choice without even realizing they had another option. So let's break it all down. Let's look at the main ways advisors get paid. Stick around to the end, because not everyone is required to act in your best interest, and I'll tell you how to tell the difference. Let's start with the oldest model in the industry. In a commission-based model, the advisor earns money when you purchase a product. It's as simple as that. This could be an insurance policy, an annuity, certain mutual funds, or other investment products. You don't write a check directly to the advisor. Instead, the product company pays them, and it's all built into the price. So what does it actually look like in dollars? Well, upfront commissions on products like annuities or whole life insurance, they can range on average between 3 to 6% of the price. There may also be trailing commissions, things like 12B1 fees. They can run quarter of a percent all the way up to 1% annually on certain mutual funds. Those stay with you as long as you're invested. Now, here's a concrete example. Let's say you purchase a $100,000 annuity with a 5% commission. Your advisor earns $5,000. You don't see that money leave your account directly, but it's baked into the fees and surrender charges associated with the annuity. Now, there's some legitimate advantages to this model. There's no direct out-of-pocket cost at the time of purchase. So you're paying for the product. If you're happy with that price, then it might be right for you. It can make it accessible to people with smaller account balances who might not meet minimums that other advisors charge. It can also make sense for one-time product needs. But there's some severe limitations here too. The structure, it can create inherent conflicts of interest between the advisor and the consumer. An advisor might be incentivized to recommend higher commission products, even if a lower commission product would serve the person better. The advice here is typically going to be limited to the types of products that the advisor can sell you. And ongoing trailing commissions can make it hard to understand what you're actually paying for the products that you receive. Now, if you appreciate knowing what things actually cost, consider subscribing. It's not going to cost you anything. And to disclose my own conflict of interest here, helps the algorithm show this information to more people. So we both win. Now, overall, the commission model might work for somebody who only needs a specific product, like a term life insurance policy, and they're not going to be looking for ongoing comprehensive advice. But if you need guidance across your entire financial life, commission-based advice has significant limitations. Next up is assets under management, or AUM for short. Here, you just pay a percentage of the investment assets that the advisor manages for you. They can deduct the fee directly from your accounts because they have access, which just means you don't need to write a check. You pay automatically. It's by far the most common model out there today. According to industry researchers at kitsis.com, 86% of advisory firms are using the AUM model as their primary fee model. So what does it all cost? The industry median is approximately 1% for portfolios up to $1 million. Fees are going to generally decrease as portfolio size increases using what's called a graduated fee schedule. A $1 million portfolio at 1% costs you $10,000 a year. A $2 million portfolio might be charged 0.85%, and that would be $17,000 a year. So you might notice something there. Even with a lower percentage, the person with twice the assets still pays significantly more. But ask yourself, does the advisor's work scale the same way the fee does? Maybe. Maybe not. There's some genuine advantages to this model. The advisor's compensation is directly tied to your portfolio growth. So there's some alignment of incentive there. You often get ongoing relationships, and it may contain comprehensive planning services. They can be bundled into that fee. It's easy to pay since the accounts are linked and the advisor can deduct your fee automatically. But there can be some drawbacks too. The fee is going to scale with the portfolio size, regardless of actual work performed, and it can become expensive for larger portfolios who have simpler needs. Also, advisors may limit the scope of their advice to the assets that they manage and nothing else. If you don't immediately have assets to transfer over to their firm, or if you want to maintain control of your money, that advisor may not be willing to work with you. The AUM model works well for people who have significant liquid transferable assets and they want to pass off the management responsibilities in full to somebody else. If your primary need is having someone actively manage your portfolio or you value knowing someone's watching it daily, the AUM model can make sense for you. But if you're somebody whose wealth is spread across various accounts, maybe you can't move them like a 401k, or maybe your planning needs extend well beyond your investments, then the fee structure may not match the value that you're receiving. Which brings us to a model that's been growing in popularity, especially among people whose financial lives don't fit nice into that neat little box of portfolio management. In a flat fee model, you pay a fixed dollar for the advice, regardless of your portfolio size or your net worth. This can be structured as monthly payments, quarterly, or even an annual retainer. Some advisors will charge a project based flat fee for one time plans, and the fee is based on the complexity of your situation, not how much money you have. So, how much does this typically cost? Well, ongoing retainers generally run a few $1,000s a year, and they can go up from there, all depending on the complexity of your situation. Now, planners may offer one time comprehensive plans for you with no ongoing services. You just have to see what's out there. The cost here is transparent and it's predictable. You know exactly what you'll pay up front and the services you'll receive. The advisor is compensated for the advice they give, not the size of the portfolio they manage. And it's accessible to high earners who haven't yet accumulated large liquid portfolios that they can transfer over. Now, one thing I particularly like about this model is that the advice, it can cover your entire financial picture, including assets you can't transfer. There's no conflict around recommending you do things like pay down your mortgage or max out your 401k because the advisor's compensation isn't tied to how much money they're managing for you. In a flat fee model, there's no financial reason for someone to steer you away from good advice. Now, there are some drawbacks to be aware of here. Sometimes you have to budget for the explicit fee rather than having it automatically deducted from your account. The service with a flat fee model may or may not include investment implementation if that's something you're interested in. But all of that would be defined in your service agreement upfront from the beginning, and you would know what you would receive. A related model here is an hourly advice model where you can pay for the time you use. Rates like $200 to $400 per hour are common. It works well for people who are more of DIYers and just want occasional guidance or a second set of eyes on what they think is best. Now, flat fee tends to work well for people whose complexity extends beyond their investment portfolio. Maybe you have high income, but most of your wealth is tied up in a retirement plan, maybe stock options or real estate investments. Maybe you're navigating a career transition, the sale of a business, or you need integrated tax planning along with investment management. People who need comprehensive advice but don't want to pay based on the size of their portfolio are generally a good fit for the flat fee model. Now, this is the model I use at my practice, Flow Financial Planning, because it aligns the fee with the advice rather than the account balance. Now, regardless of which fee model an advisor uses, there's always one more question you should ask. Now, you've probably heard the term fiduciary thrown around a lot, but what does that term actually mean? Well, a fiduciary is someone who's legally obligated to act in your best interest. They have to put your needs ahead of their own. They must disclose conflicts of interest so you know why they're making the recommendations they are. Simple enough in theory, but who actually qualifies to call themselves a fiduciary? CFP professionals have a fiduciary obligation. The CFP board's code of ethics require them to act in your best interest at all times when providing financial advice. Now, this applies regardless of the compensation model they use. Broker dealers, they operate a little bit differently. Since 2020, they've been subject to something called Regulation Best Interest, or Reg BI for short. This requires them to act in your best interest at the time when they're going to make a recommendation. They also should be disclosing all conflicts of interest. However, Reg BI is not the same as a full fiduciary duty that applies throughout an entire relationship. It's just a standard that kicks in at the point of recommendation. It's not an ongoing obligation for them. So when you're interviewing an advisor, ask directly, are you a fiduciary 100% of the time in our relationship? A yes or no answer is going to tell you a lot about how they operate. Now, here's how all this connects to what we've been talking about. Fee-only advisors, whether they charge AUM, a flat fee, or even hourly, they eliminate product sales conflicts of interest entirely. They don't earn commissions from selling you anything. Commission-based advisors have inherent conflicts that need to be disclosed and managed. That doesn't make them bad people, but it does mean that you should understand the incentive structure and the price behind the product you're buying. Now, the fee model alone, it doesn't make somebody a fiduciary, but a fee-only structure does remove one of the major sources of conflicts of interest in our industry. The best advisor for you isn't necessarily going to be the one with the lowest fee or the fanciest credentials. It's the one who has a fee structure, a service model, and a legal obligation that aligns with what you need from a financial advisor. Now, you have the framework to go out there, figure out which one's the best fit for you. Thanks so much for watching. I'm Jordan Drinkhouse. If you want to work with me on your financial plan, there's a link in the description below for a free consultation call. And don't forget to subscribe. I'll see you in the next video.